Welcome back, you legends. I'm Dr. Cal. Long time no see. I'm back, and you know when I'm back, things are about to turn real crazy. The market is set for a little bit of a rally and then a protracted, large correction slash potential bear market. So let's talk about it. And this chart, the Nvidia monthly chart, really gives us the whole picture. So let's get right into it. Let me enable the moving averages. I just want you to focus on this single moving average. This is the 10-month moving average. And I want to show you what happens every single time Nvidia breaks this moving average. Let's go back all the way to 2018 in this beautiful uptrend market, rallying, Nvidia leading. Look at this, above the 10-month moving average every single month until October 2018. We break below the 10-month moving average, and the result is a 56% correction. Nvidia price cut in half. What happens in 2021? Exact same thing. Look at this, above the 10-month moving average every single month. Even when we wick through it, we close above it every single time. The only exception happens April 2022. And what's the result? A 68% correction from the top. And from the break of that month, we lost 58%. So every single time Nvidia breaks below the 10-month moving average, we get a 50% plus repricing in Nvidia, an adjustment of valuations. It doesn't necessarily have to be something macro, something big. Usually it's just the readjustment of growth expectations for the stock and the stock market in general that leads to valuations coming down. And when valuations come down, that means stock prices go down. Okay, where are we now? Look at this. Look at this. We broke below it, closed below it last month. We're now getting a bit of a counter rally. This is likely the last counter rally we're going to see in the market and in Nvidia before the next very large correction. So we broke below. I'm now expecting at least a 55% correction. I'll talk about that in a bit here, why. But I want to show you something else. Look at the RSI. Just look at it. When we close below the 10-month moving average, we're trending down below the moving average for the RSI. Then we broke below the overbought conditions on the monthly chart, and that led to a huge correction. Same thing happened. Look at this. 2022 January, we broke below the moving average on the RSI, and that resulted in a protracted correction. Look at this. Perfect break last month, and we're now getting a counter rally. Now I'm expecting a large correction, 50%, something like that. But I don't expect it to happen immediately. Now let's get into the nitty-gritty details. I'm starting with Nvidia because where Nvidia goes, the rest of the market goes. If you like this kind of analysis and you want to get it every day in real time, I post all of that in the Discord trading community. You can sign up through Patreon, Money Time Machine on Patreon. It's $29.99 a month. If you sign up for a whole year, you have to sign up for a whole year and click pay annually. If you want to sign up and pay monthly to try it out, it's $55 a month. If you want to get direct access to me, to be able to directly message me so I can look at the setups that you're looking at, specific positions you're in, you want tips on, all that kind of stuff, then look for the Living Legend membership. I've been gone a while from YouTube, but I've continued my work in the trading community every single day, posting my analysis, my outlook, trade setup, investment ideas, as well as answering every single question asked by every single member. Let's take a look now at the daily chart, and I'll explain everything. Now, we've had multiple higher highs, each successively very slightly higher than before, until we had this bearish engulfing candle breakdown on DeepSeek. Now, I don't think DeepSeek negatively affects Nvidia in any way. I think this huge negative reaction is a testament that investors are extremely nervous about anything, and they just used the DeepSeek as an excuse just to sell. It's not a headwind in any way. In my professional opinion, I've covered semiconductors for 10 plus years, but the market is just looking for any excuse to sell. Nvidia is up over 1,000% from the October bottom of 2022. It's been in this very clear distribution pattern that will likely look like a Wyckoff distribution break, form a false breakout, then come down and bring the large correction. So why 55%? Simply because that's historically been the case. And then we have this beautiful gap at 67.38 that will very likely get filled this year once we get this correction going. So the way I'm looking at this is Nvidia and the market will likely continue to rally potentially for 1 to 2 weeks into Nvidia's earnings at the end of the month. Then very likely Nvidia continues to rally after earnings for a couple of days just to price out all of the premiums in the options chain. That is usually what happens. All of the put and call holders get crushed after earnings. Those option chains get repriced. We get very likely a new high, and then we get the crash. Now, this has been the MO for Nvidia for ages, and I'll show you several examples. Look at this. This is 2021, the November earnings report. Nvidia does, in fact, rally first for 3 consecutive days, and then we get the correction going. In 2018, Nvidia actually rallies for 6 weeks after earnings. So folks looking to short Nvidia on earnings will likely lose out on a lot of money. Nvidia does not tend to want to crash immediately after earnings. It tends to report and then gets repriced down. Look at this. Reports, pulls back slightly, rallies again, makes new high, then distributes for a while, final false breakout, and then we get a huge correction that lasts several months and sees 56% of Nvidia's price cut. This is the big picture on Nvidia. I'll cover it later in more detail in a separate video to show you how to make 1,000%, 1,000%. That means you put in $10,000, you make $100,000 shorting the next Nvidia crash, the next big short. I'll cover that in a separate video. Now let's take a look at the S&P 500 and the overall markets, and let's dive deep into what's going to happen next in the next several weeks and when I expect that next large correction to take place. This is the daily chart for the S&P 500. This is the RSI. This is the stochastic with my proprietary settings, and this is the PPO or the MACD. It's pretty much the same thing. So let's talk about the S&P 500. We had this very small correction, about 5.5%. That's typical for the S&P 500. Then we had this breakout, and now we're consolidating. Now we've rejected this 610, 609, and 608 level 3 consecutive times. We formed this bearish engulfing candle on Friday. We opened above the prior day and closed below it. Typically, this means we get follow through day the next day. This doesn't always mean we crash or gap down. Not necessarily the case. And I'll show you a few examples that happening in the market actually just forming a hammer candle and bottoming. Here's an example, not quite a bearish engulfing, but a huge bearish candle. Then we got a couple of hammers, and then we bounced back up. Let me show you a few other examples. Here we had a bearish engulfing candle, then the market basically moved flat, right? It did not crash, didn't do anything crazy. This is the perfect example here. Bearish engulfing candle followed by a hammer candle, bottom, and we rally. What am I saying exactly? What I'm saying is this is way too obvious. Triple rejection, pretty much at the same level. We're forming kind of what looks like a bull flag to me, even though the flagpole is kind of short. Doesn't really matter. That's okay. The key here is this low needs to hold, and preferably this low also needs to hold. So if we form a hammer candle that looks like this, in my opinion, that means we likely bottom, get that final rally that we discussed earlier in the video, form the top in February, very early March, and then get that correction in March, April, and May. Yes, I'm expecting a protracted kind of correction. Now the stochastic, it did fail to produce a bullish cross, right? It came in close, then failed. Typically that means we're still consolidating. The market has not made a decision yet. Volumes not overly convincing in my opinion. The market is still moving sideways. It's waiting for inflation. The inflation report that comes out this week. Last week, Friday, we had unemployment come in below expectations. That is neither here or there, not bullish or bearish. That was okay. However, non-farm payrolls came in significantly below expectations. So non-farm payrolls came in cold. Unemployment data came in hot. So that was mixed data. And then the market had that freak out on these two readings, the inflation expectations and the consumer sentiment. Consumer sentiment dropped down significantly and inflation expectations, look at this, went up significantly from 3.4% to 4.3%. Now, speaking frankly, this kind of data, sentiment, inflation expectations, doesn't really matter. Okay, it doesn't really matter. It was used as an excuse to pull back from resistance. Totally fine with me. This is not a long-term important data point, in my opinion. What really matters is unemployment data and inflation. We want inflation to continue to move down, and we want unemployment to basically remain flat. We don't want a sudden rise in unemployment. That will mean a recession is on the horizon. We don't want another spike in inflation. That means the Fed will have to maintain rates higher for longer, and that accelerates the prospect of a recession even more. So in the grand scheme of things, the market sold off on data that is not really critical. It's not the trend-setting data. That's number one. Number two, we rejected that resistance, formed a bearish engulfing candle. Kind of way too obvious, to be honest. Triple rejections now here. Kind of too obvious. I think what happens next is we get a hammer candle, some kind of bottoming candle over the next couple of days. Then we rally if inflation data is good enough, and I think it will likely be okay. Then we get a high, and that puts in the top for the first half of the year, and then we get a large correction, at least 10% for the S&P 500 and probably more for the NASDAQ. So why am I more confident in a rally rather than a continuation of the selling, or at least a higher high first and then a sell-off? I'll show you why. Let's take a look at the weekly chart. Does this look like a bearish chart? It really doesn't. Higher lows, right? Consecutive higher lows, consecutive higher highs, and now we're consolidating with triple green candles. Does not look like distribution to me. Let me show you what distribution looks like typically. This is what distribution looks like. Indecision, sell-off, rally, sell-off, rally, sell-off. That's what distribution looks like. In this case, we had the market buy up every dip. We gapped down, we rallied, we gapped down, we rallied. So dip buyers still looking to buy the dip. Now that's one point. Let me show you the second point. Now let's discuss another important weekly chart development, because the weekly chart remains bullish. All of these green candles closing above the average volume on the weekly chart. Plus, look at the stochastic. Cross down and about to cross up. Crossed down and about to cross up. What happened in this case? The market had already completed a correction, was rallying for the final time before putting in that top and beginning a large correction. In that case, that was a year-long bear market. In this case, the stochastic, excuse me, is about to cross up. We're still consolidating. I think we need one final rally, right, to get that euphoria going, and then we get the correction. The stochastic seems to be indicating that's the case on the weekly chart. The overall weekly chart structure also seems to indicate that is the case. Even if I look at the monthly chart, it does not look bearish. It is just consolidating, very clear rising triangle. It's just waiting for a breakout. Now, what would invalidate all of this immediately? It's if the S&P 500 and the NASDAQ begin a large sell-off. this week and close red. They have to break below the low of last week. Now, another bullish indicator is what's happening with the NASDAQ. Let's take a look at the NASDAQ weekly chart. Look at this indecision candle. Then we gapped down, rallied, and last week we formed a higher high intro week and then a higher high at the end of the week. This means the NASDAQ is now leading, right? Because the S&P 500 formed a slightly lower high this week, right? And a lower low this week. The NASDAQ did not do the same. Higher low, higher high, higher close. It means there's money rotating out of defensives and into tech and growth. That is a risk on signal. In addition to that, let's take a look at the daily chart for the NASDAQ, still trading within this channel. I drew this channel as soon as we formed these couple of lows, right? I connected the lows and the highs. We're now forming a channel that looks a lot like this. In addition to that, the NASDAQ did not make a higher high in January or February. The market, the S&P, did make a higher high versus November, right? That November election rally, we did make a slightly higher high. I think the NASDAQ needs to now continue to lead and make a higher high. Now let's take a look at the Russell, still very weak, and that has to do with the market breadth being weak. Now this is the 50-day S&P 500 market breadth, and it looks at the percent of stocks in the S&P 500 trading above their 50-day moving average. Look at this, market making new highs versus this prior high, breadth making significantly lower high. Again, if I take a look at the 200-day breadth, and this is the gold standard breadth, look at this huge bearish divergence. Lower high on breadth, significantly higher high, the S&P. So if you've actually been losing money or stagnant, not making any progress since November, it is because the vast majority of stocks in the market and in the S&P 500 have been declining. Only been a handful of stocks that have been leading the market. The vast majority have been declining. Even tech stocks, things like Microsoft and Apple that usually lead, have actually really struggled to make new highs. So if you've been wondering why your positions are not gaining any traction, not making you any money, especially if you're a stock picker, it's because the market has been losing breadth. The vast majority of stocks have been declining. Only a handful of stocks have been leading the market higher. That's why the Russell is still struggling. It is still suffering. However, we get that final rally in February leading into Nvidia's earnings, we should get a nice breakout in the Russell. What to look for is 2 consecutive daily closures above the 50-day moving average, or simply a daily closure above this level at 230.6. Now, another encouraging development is this is the NASDAQ 100 relative to the S&P 500. This is a relative chart. This is the S&P. This is the NASDAQ. What's important here is the market tends to rally when the NASDAQ is leading. The market likes to see growth lead. We do have some bullish developments here. We have this resistance line. It was rejected once, twice, 3 times, 4 times. However, the more times we hit a resistance line, the more likely it actually breaks. In addition to that, look at the stochastic, formed a bullish cross here, another bullish cross. This means we have a bullish divergence because this is a higher low versus a lower low on the ratio chart, as well as the fact that the NASDAQ formed a higher low versus the prior week when the S&P made a lower low last week versus the week prior. This tells me the NASDAQ is leading, and we will likely see tech lead the market in this next little rally, likely to go back to these highs, 538, and potentially even exceed them to make a new high before the next correction starts. Now, if I take a look at the VIX formed a bullish engulfing candle last week as the market formed a bearish engulfing candle. Right now, it's 3:30 a.m. Eastern time. The pre-market session is about to begin 30 minutes from now. The futures are already up significantly. This reinforces the idea, to me personally, that this was too obvious. Triple rejections, kind of too obvious. Sell off on news that doesn't really matter that much. The data that matters the most came in mixed. It wasn't bad, it wasn't good, it was just okay, right? Now we're waiting for inflation. I'm looking for a consolidation, a couple of consolidation bottoming candles ahead of inflation, the CPI data, or potentially even recovery ahead of the CPI data, and then a rally on CPI, likely allowing the S&P to make a new high and the NASDAQ to also make a new high. So with that being said, let's talk about the futures chart. This is the 4-hour futures chart. This is my own proprietary combination of settings, and we call these bottoms over the last couple of weeks. Now, my personal expectation for a bearish kind of turnover was market bottoms here, right? Breaks its prior low, rallies, fills these couple of gaps, then rejects and comes down. As soon as we had this breakout, that told me that we will likely have another leg of rally, especially if we break this resistance line. So far, we did not. We had a false breakout, then rejected, and the market is now basically up about 0.3% from last week. Again, I'm looking at something that looks kind of like this kind of structure, right? Bearish engulfing, kind of way too obvious of a double top. Then we get a hammer candle, fill the gap from the prior day. Then we rally on good inflation data, form a top, and then we get that large correction. That's kind of what I'm looking for in the next couple of weeks. Again, the NASDAQ forming this bull flag, still rejected here and here 3 times now. However, unlike the S&P, the NASDAQ is making higher lows. That is positive. To me, that says this is likely now a bullish pennant, and we're looking for one final breakout to shake out all of the bears, make a new high, trap all of the bulls here that will be chasing new highs, and then get the correction going. So again, the VIX triple bottom here, it needs to break this low and go back all the way down to fill this prior gap that was left from November at 12.9. I think as soon as we break below this low, this will give us an additional indication that we have another leg of rally before the market sells off. So far, the VIX is looking like it wants to bounce even more. It wants to go up even more. However, as long as we don't exceed this high, I think we will be fine still. This is the VIX front month versus back month volatility. I use it to call bottoms and tops. When we're super extended, it calls tops. When we're super oversold, it calls bottoms. Right now, we're kind of hovering at the lower range, not overextended or oversold, just at the bottom of the range. Typically, this means we're still consolidating and we'll get more upside. XLY versus XLP. This is consumer discretionary versus staples. It is crashing because Tesla is crashing, and Tesla has a lot more downside to go. It hasn't bottomed yet. It is losing sales, margins, profits. It will likely guide even lower as Tesla sales continue to suffer in Canada and throughout Europe, absolutely getting destroyed, primarily because of political resistance to Musk. And you know what I absolutely hate in any stock? It's when it becomes political. You want to get the heck out of any stock that becomes too political, because it will trade a lot based on news. And that means high volatility and low return, low risk adjusted return. And that's the case for Tesla. It rallied all the way to my target of 400 plus. Look at this, 400 plus, breaking this prior high. That was my target for Tesla by the end of last year, was about 400. It rallied all the way to that target, and now we have a long way down for a correction. In the near term, it at least moves back down to fill this gap at 330. In the medium term, overall, 3-4 months from now, I think it goes all the way down at least to 275, even lower to fill this gap. So I am absolutely bearish on Tesla in the near term and in the medium term. Once we're back at these levels, I think Tesla will be interesting again for another long trade. Now let's take a look at the S&P relative to gold. This is a risk on, risk off barometer, and look at this. The S&P relative to gold has been absolutely suffering, declining as gold has been rallying. This is a clear risk off signal. And the last time we had something that looked like this was back here. The market had actually been slightly making higher highs, and then the straw that broke the camel's back is when we had this breakdown and we had this correction in the market. So from this perspective, the market is still risk off. Risk off assets like treasuries and gold are actually leading the market, but that will very likely change very soon as the NASDAQ makes this breakout relative to the S&P and rallies higher. That'll be a risk on signal, and money will flow out of treasuries and gold and back into the NASDAQ 100. If I take a look at high yield bonds relative to short-term treasuries, so this is a risk on versus risk off barometer. We're moving sideways. Momentum is slowing down. Overall, it looks a lot like this period. Eventually, we had this one final breakout, and then we had the correction, but we likely have one final breakout, and then we have the correction. If I look at the put to call ratio, it did print a sell signal last week, and as a result, we had that pullback on Friday. However, I want you to pay attention to what happened here, right? The first sell signal resulted in a rally with a higher high. Then we had kind of a double bottom, right? See it? Double bottom in the put to call ratio, and then we had that massive breakout in the put to call ratio and the sell-off, kind of looking at something that looks similar to that, right? Double bottom, then we get the sell-off, double bottom, then we get the sell-off. So generally speaking, we don't want to go short on the first sell signal. We want to go short on the second sell signal. That means we likely have a little bit of an upside here, and then we get the sell-off. I'll report immediately as soon as we get that sell signal, so you guys are all aware, and so you can manage your risk accordingly. Now, let's briefly talk about the three horsemen of the apocalypse. That is bronze relative to the S&P, that is TLT relative to SPY. We need this to break and close above the 10-month moving average. That would be the first major sell signal. The second is I need consumer staples relative to the S&P to break above and close above the 50-week moving average. And the third and final sell signal is the yield curve reversion. Right now, out of the three horsemen of the apocalypse, we have only one sell signal. It is the yield curve reversion. We need number two. We need staples to lead the market, and we need bonds to lead the market. And when that happens, when all of the three signals are triggered, what happens is we get a recession-led crash. That was the last time all of these three signals happened. It was in late 2007, and we had that crash. So is a recession coming? Yes. Do we know when exactly? No. Is it time to short, to go really crazy with shorts for a recession? Not yet. We're not there yet. I need the three signals to all be positive, and then I'll be looking to short this kind of 50% plus crash. In the meantime, I'm looking for near term, higher high, then a larger correction, into May, and then we get another rally into the end of the year as economic conditions continue to deteriorate, and then we get that massive crash. We're not there yet. The signals are not there, so it's way too early to talk about that. But I wanted to mention it just in case you were wondering about when the big short is ready. Now let's talk about fear and greed. Still at fear, 39. We're not at greed, even though we're near all-time highs. The market is not at greed. It is still at fear. Strength is slightly improving. Breadth has been declining. As I showed you, put to call ratio has been rising. Market volatility has been rising. Overall, the market is extremely nervous heading into this week's inflation data. So what do we have this week? We have Fed Chair Powell testifying tomorrow, Tuesday. But the big data comes in CPI Wednesday before the market open, plus the Fed chair test. So still expect a lot of volatility, consumer inflation expectations today at 11 a.m. So if we get a dip in the early market, first 30 minutes, look for a rally after consumer inflation expectations. If we get a rally before this report, look for a dip after the report. Usually the market loves to do the opposite of what it ends up doing after a report like this drops. So the biggest and most important volatility event is going to be Wednesday. If inflation finally comes in, if we finally get a decent report on inflation, then they'll be looking for the VIX to finally break these lows. That'll be the signal for significantly higher highs from here, at least for a couple of weeks before we get that large correction. Thursday, we get PPI. Friday, we get retail sales. So a lot of data coming up this week. Now, seasonally speaking, February and post-election years tends to be negative in the second half of the month. Not always the case. Sometimes we actually make slightly higher high in the second half of the month, and the correction comes in March, April, and May. So if we do actually get that rally in the next couple of weeks, if the market does end up making that higher high before the correction, then look for something that looks like this: a rally in February, lower high in March, and then that large correction the rest of the March and April, May. However, if we get that big correction start immediately after CPI, which is absolutely possible, then look for a huge correction in February, early March, and then a recovery for the rest of the first half of the year. Now, based on what I'm seeing from the weekly chart to me seems to indicate that we will likely get a higher high first, and then we get the correction. That's from the stochastic, the structure of the candles, and the fact that the NASDAQ is now leading the market again. All of these signs tell me that we'll get one final push led by tech, and then we get the correction. Smash that like button on your way out if you enjoyed the video. If you watched till the end and you did not enjoy the video, I thank you for your time and attention. I'll be back with my Nvidia 1000% trade idea in the next few days. You want to make 1000% shorting Nvidia, you want to know exactly how to do it, how the setup works, exactly when to enter, what to buy, what to sell, all the option structures. Stay tuned for that video. Thank you, folks, and I'll catch you in the next one.